A piece of your very next paycheck's retirement contribution could end up loaned directly to a company you've never heard of. The kind of investment that used to require being a pension fund, an insurance company, or a billionaire just to get access to. And there's a real chance you won't have to click a single button for it to happen. It could just be the new default setting on the fund you're already enrolled in. That's not a hypothetical. BlackRock has said it plans to launch target date funds, the set it and forget it option most people are auto-enrolled into, with private market investments built in, scaling up to around 20% of the portfolio depending on your age. Empower, one of the largest 401k providers in the country, said it's doing something similar this year. And target date funds aren't some niche product. They're already the single most common investment inside American 401ks, precisely because they're the default. Most people never touch the setting. That's the entire point of a default. It's the option that requires no decision at all.
Financial crisis after another.
It's going to crash the economy.
We are headed for a U.S. dollar crisis.
The cascading impacts of this economic crisis haven't even begun to hit them.
I'm worried about something worse than a recession.
When this thing crashes, it's going to be like mashing up the dot-com thing with the financial crisis because this is so much larger.
This video is going to answer 3 things. What is Wall Street trying to move into your retirement account? Why now? And what happens if it goes wrong while your money is the one sitting inside it? Keep one sentence in your head as we go, because I'm going to come back to it. Every dollar of risk that leaves a Wall Street balance sheet has to land somewhere. By the end of this video, I'll show you exactly where it already landed. So why does an industry that spent decades only dealing with pensions, endowments, and the ultra-wealthy suddenly want access to your 401k? It's not because they had a change of heart and suddenly discovered a passion for helping teachers and plumbers retire comfortably. Private credit, direct loans made to companies by non-bank lenders, is currently a roughly $2.1 trillion asset class. And the firms running it aren't quietly optimistic. A BlackRock report from October 2025 flatly expects the category to double in size by 2030. Here's the catch. Their usual customers are running out of room. Pensions and insurers can only hold so much illiquid, hard-to-sell debt before their own risk teams, and in the case of insurers, actual regulators, start pushing back on how much of the portfolio can sit in assets that can't be sold quickly if needed. Some pension funds have reportedly already hit self-imposed limits on how much of their book they're willing to put into private markets. So the industry needed a new pool of capital. A big one. American retirement accounts happen to hold about $8.7 trillion. One analyst, Brian Payne at BCA Research, described the policy shift opening 401ks to private markets as an exit ramp for the current situation going on for private equity. That's not spin from a critic. That's an industry analyst's actual read on what this is for. Not a growth opportunity for you. An exit ramp for them. Your retirement account as the shoulder on the highway they get to pull into when their own traffic backs up. And while that pool of new money was being lined up, the rules quietly changed to make grabbing it easier, and to make it harder for you if it goes wrong. In August 2025, an executive order directed federal agencies to clear the path for private equity and private credit inside everyday retirement plans. In March 2026, the Department of Labor proposed a formal safe harbor for the fiduciaries who decide to add these assets to your plan. In plain terms, that phrase means this. Under existing law, a plan sponsor, your employer or the company they hire to manage the 401k, has a legal duty to act in your best interest when choosing investment options. If they pick something reckless and it blows up, you can potentially sue over that. A safe harbor creates a defined set of steps a sponsor can follow that shields them from that liability, even if the investment itself performs badly. It's legal protection for the people making the decision, not for you, reducing their exposure if the investment they picked for your account blows up. An industry that needed new capital got access to yours at almost the exact moment the rules shifted to make it harder to hold anyone accountable if that capital gets mishandled. That's not a theory. That's just the order the dates actually happened in. This stopped being theoretical in September of 2025.
That's when a subprime auto lender called Tricolor collapsed into liquidation, amid allegations it had pledged the exact same car loans as collateral on more than one loan at a time, meaning multiple lenders each believed they had a legitimate claim on the same asset, which is roughly the financial equivalent of selling the same house to 3 different buyers. Weeks later, an auto parts company called First Brands filed for bankruptcy with over $5 billion in debt and its own allegations of manipulated financial reporting. Both companies had spent years quietly borrowing through private credit, specifically because it came with less public scrutiny than a traditional bond or bank loan would have. Pledging the same collateral to multiple lenders isn't creative financing. That's the plot of a heist movie, except nobody's supposed to find out until the sequel. JP Morgan CEO Jamie Dimon, watching this unfold, said something that ended up everywhere in financial media. When you see one cockroach, there are probably more. Look at what those 2 collapses actually did to the people who'd already put money in. Tricolor's bonds that carried a AAA rating from Kroll, the highest rating that exists, are now trading around 12 cents on the dollar. First Brands' top-tier loans are worth roughly a third of what they were issued at. It didn't stay contained. UBS disclosed more than $500 million in exposure to First Brands. Jefferies flagged $715 million tied to what it carefully called questionable receivables. 2 regional banks, Western Alliance and Zions, separately found what they described as fraudulent activity from their own borrowers in that same window. The Financial Stability Board has since warned that banks globally are sitting on hundreds of billions in private credit exposure, direct and indirect. To be precise about what actually happened here, this wasn't retirement money. This was institutional money. Banks and funds paid specifically to catch exactly this kind of thing before it happens. And they didn't catch it. Part of why is structural. Private credit loans are negotiated privately between a borrower and a lender, without the public disclosure requirements that come with a bond sold on the open market. Less sunlight was the entire selling point for companies like Tricolor and First Brands. And it turned out to be exactly the kind of darkness fraud needs to survive. Which leaves an uncomfortable question hanging over everyone about to hand this same asset class to ordinary 401ks. If the professionals missed it, what exactly is protecting you? None of this is 2008. Nobody serious is claiming that. But the shape should look familiar to anyone who lived through it. Complex debt, thin disclosure, and confidence that outran the actual underwriting, right up until it didn't. Remember what I asked you to hold on to at the start of this video? Every dollar of risk that leaves a Wall Street balance sheet has to land somewhere. It landed here. In early 2026, Blue Owl Capital had to gate redemptions on a $1.6 billion fund called OBDC2, a fund marketed directly to retail investors, not institutions, often through financial advisors pitching it as a way to earn higher yield than a typical bond fund. Retail interval funds like this one are typically marketed hardest toward retirees and near retirees, specifically chasing yield. Precisely the group with the least room in their life to absorb a 45-day wait and a 70% haircut on money they may have been counting on. When withdrawal requests surged 200% above normal, Blue Owl couldn't pay everyone out.
It moved to a liquidation plan that returned roughly 30% of investors' capital, spread over a 45-day window. Regular people, the kind of investors this whole policy shift is designed to bring in at massive scale, put money into something they were told they could access. When they actually tried to get it, they got about 30 cents on the dollar back, and had to wait over a month even for that. That's not a warning about what private credit could theoretically do inside a retirement account. That's the exact mechanism already happening to the exact kind of investor this policy shift is about to hand your 401k to. The reason this keeps happening comes down to one structural mismatch. And it's worth understanding because it explains why this gets worse, not better, once it's sitting inside a 401k.
Private credit is built for money that can sit locked up 7 to 10 years. Investors get compensated partly for accepting they can't touch it. Most funds cap redemptions around 5% of value per quarter, specifically so a rush of withdrawals can't force a fire sale of illiquid loans all at once. Retirement accounts don't run on that timeline. People change jobs and roll over accounts. People hit real financial hardship and need emergency withdrawals. Everyone eventually hits required minimum distributions at 73, whether the market is convenient that year or not. You've got an asset built around money that won't move, sitting inside an account type built specifically to let money move whenever life requires it. Think of it like a landlord who needs 60 days notice before you can get your security deposit back. Except the landlord in this case is holding a slice of your retirement, and the 60 days can quietly turn into 105 if enough other tenants ask for their deposits back at the same time. Blue Owl's Gate wasn't a fluke. It was that exact mismatch, arriving right on schedule. And it's not just the risk you're not fully seeing, it's what you're paying for it. Private credit funds commonly run fee structures around 2% of assets annually, plus 20% of profits, against a fraction of a percent most people already pay in their index funds today. Run that gap over an actual career. On $100,000 invested over 20 years, that fee difference can plausibly run into the tens of thousands of dollars in reduced final balance, even before accounting for the profit-sharing cut. And a lot of these holdings aren't priced by an open market either. They're priced by the fund manager's own internal models, the same people collecting the fee. Imagine grading your own exam and also getting paid based on the grade. Now, I'd be doing this story a disservice if I stopped there, because there's a real counter-argument, and it deserves actual weight. A lot of credible analysts genuinely believe Tricolor and First Brands are exactly what they look like: isolated fraud, not a system-wide problem. Cambridge Associates called both cases idiosyncratic, and broader private credit default rates have stayed relatively modest, around 1.5% in direct lending through 2025, lower than comparable public credit. Most surveys show a majority of institutional investors are still planning to increase their private credit allocations over the next year, not retreat from them. Proponents also make a fair point about access itself. For decades, some of the strongest risk-adjusted returns in finance were legally walled off from ordinary savers, available only to accredited investors and institutions. And there's a real argument that expanding access, done carefully, isn't inherently predatory just because it's new. So it's entirely possible everything in this video is closer to a couple of bad actors getting caught than the leading edge of a real crisis. Private credit has existed inside institutional portfolios for decades without a system-wide blowup. That track record is real. The distinction that actually matters for you specifically is this. Even the people making that case are debating whether this is safe for pensions and endowments, professionals with dedicated risk teams who can absorb a bad quarter. Nobody in that debate is arguing it's equally safe for someone's entire retirement savings, handled by someone with no risk team, figuring this out for the first time inside a fund they didn't choose. So where does that actually leave you?
The rule that would make all of this official isn't even finalized. Its comment period only just closed. Nobody actually knows exactly how far or how fast this rolls out. But BlackRock and Empower aren't waiting for a final answer. They're building the products right now, regardless of where the rulemaking lands. The private credit problem was Wall Street's problem for over a decade, sitting quietly on institutional balance sheets. It's becoming everyone's problem, whether the rule finishes or not. And unlike most of what we cover on this channel, this is one where you actually have a next step. Check your plan's fund lineup, especially your target date fund, since that's where this is most likely to show up as a default rather than a choice. Ask your HR department or plan provider 3 specific things: whether private credit or private equity is already included, whether it's planned for the future, and what the actual redemption terms look like if you ever needed that portion of your money on short notice. If the answer is vague, that vagueness is itself useful information. Wall Street didn't wait for permission to build this. Go find out if it's already in your account. Nobody's going to send you a calendar reminder for this one. If you want to see how we traced a completely different hidden financial risk, go watch the video right there on your screen next. Don't forget to like and subscribe for more.